Global stock markets are facing a downturn. Investors are worried about a possible recession in the United States. This fear is causing major indexes around the world to drop. Markets in Europe, Asia, and the US are all feeling the effects. The US economy is very important for global growth. When it shows signs of weakness, it makes investors nervous. They start to sell their stocks and look for safer places to put their money. This selling is what is driving the market down. Several factors are feeding these recession fears. Inflation is still a problem. The US central bank is raising interest rates to combat it. This can slow down the economy. There are also ongoing issues with supply chains, making it hard for businesses to get the goods they need. All of this adds up to a lot of uncertainty. Businesses and investors don't know what the future holds. This makes them hesitant to spend or invest, which can further slow down economic growth. Asian markets were hit especially hard during this global downturn. Japan's Nikkei 225 index had its worst day since 1987, dropping more than 5%. This dramatic fall shows how worried investors are about the current situation. Several factors contributed to the Nikkei's plunge. Japan's economy is closely tied to the US economy. If the US goes into recession, Japan will likely feel the effects. Additionally, a strong US dollar is bad news for Japanese companies that sell their products abroad. Other major indexes in Asia also suffered losses. Hong Kong's Hang Seng Index and China's Shanghai Composite Index both closed significantly lower. This widespread decline demonstrates the interconnected nature of the global economy. The situation in Asia highlights the global reach of a potential US recession. When one of the world's largest economies stumbles, the effects are felt far and wide. This interconnectedness is a key characteristic of the modern global economy. Adding to the gloomy economic picture are signals from the US Treasury bond market. The yield on the 10-year Treasury note, a key indicator of investor sentiment, fell sharply. This suggests that investors are seeking safety in government bonds, a classic sign of recession fears. The 10-year Treasury yield is used as a benchmark for many other interest rates. When it falls, it means borrowing costs are going down, often because investors expect slower economic growth and lower inflation in the future. Furthermore, the US dollar strengthened against other major currencies. This is another sign that investors are looking for safety. They see the US dollar as a safe haven during times of uncertainty. While a strong dollar can make US exports more expensive, it also makes imported goods cheaper, which can help to control inflation. The future strength of the dollar will depend on how the US economy performs and how the Federal Reserve manages interest rates. Section 4. Interconnectedness breeds uncertainty. The recent market turmoil underscores a crucial point. The global economy is deeply interconnected. Events in one part of the world can quickly ripple through financial markets and impact businesses and economies across the globe. The fear of a US recession is not just an American problem, it's a global concern. The US economy is so large and influential that its performance has significant implications for countries around the world. This interconnectedness can amplify both positive and negative economic shocks. It makes it challenging to predict how the current situation will unfold. The global economy is a complex system with many moving parts. Unforeseen events can quickly change the outlook. This uncertainty makes it more important than ever for investors and businesses to be prepared for volatility. Section 5. Navigating the storm, a look ahead. The coming months will likely be a bumpy ride for the global economy. The fear of a US recession is real, and its impact could be significant. However, it's important to remember that recessions are a normal part of the economic cycle. They don't last forever. Central banks around the world are closely monitoring the situation and taking steps to try to control inflation and support economic growth. The outcome of their efforts will be a major factor in determining the severity and duration of any economic downturn. In the meantime, investors should focus on managing risk and maintaining a diversified portfolio. This means spreading investments across different asset classes, such as stocks, bonds, and real estate. It also means being prepared for volatility and not panicking if markets continue to decline. Section 6. Lessons from history, strategies for the future. The current market turmoil offers a valuable lesson. Economic uncertainty is a constant. There will always be ups and downs in the market. The key is to be prepared for both and to have a long-term investment strategy. History has shown time and again that markets recover from even the most severe downturns. While the timing of a recovery is unpredictable, the long-term trajectory of the global economy has consistently been upward. This perspective can be reassuring for investors who are feeling anxious about the current situation. Rather than trying to time the market, investors should focus on building a resilient portfolio that can weather economic storms. This means choosing investments that align with their risk tolerance and financial goals. It also means staying informed about economic developments and adjusting their strategy as needed. By learning from past market cycles and taking a long-term perspective, investors can navigate periods of uncertainty with greater confidence and position themselves for success in the years to come.